Alrighty. So in my past few videos, I've already talked about how to manage losing credit spreads as well as how to manage losing iron condor. So today we're going to continue this series on how to manage losing trades. So for today, we're going to talk about how to manage losing short puts. So let's say, for example, you decide to sell a short put because you think maybe the market might go up. So right now you have a short put position on. So for this example, I use a short put strike of around 382. So let's say, for example, the market did not behave as you have expected, right? It did not go up. Instead, it comes down, right? So at this point, most likely you will see a loss on your short put position. So what do? Is there anything to do at all? So it really comes down to exactly where the market is, right? So the first thing we want to do is to see the risk profile of our short put, right? We want to take a look at the P&L graph, which you can actually see from your broker like Thinkorswim or even the Tasty Trade platform. So this is the short put risk profile. So the first thing you want to do is to identify where your short put strike is, and that is at this point down here, right? So at this point down here, you can see it goes all the way down here. This is where your short put strike is, but you notice that your profit and loss, or rather your loss, does not happen until after this point down here. So you can see this red line down here. So this is actually your break-even point. So that means to say that even though the price may go past this short strike of yours, you are still not necessarily in a loss if it stays above the break-even by expiration. So as long as it's above this break-even point by expiration, you will still be in a profit. So the only time that you will lose at expiration is only past your break-even point. So this is what we want to take note of. That is your break-even point. Now you will notice that there are two lines down here on this P&L graph. You notice there is the purple line and then there is the green line, right? So if you are new to reading this P&L graph, basically the green line is the P&L for your short put at expiration. Whereas for the purple line is basically the P&L graph for today, right? So every day it will change, right? So as days pass, this purple line will slowly go up to fit to this green line down here. So what it means is that as the position matures, right, as days pass, this purple line will slowly start to go up in a profit. So that means to say, even though if today, if the market goes all the way down, let's say to around 385, which is somewhere down here, what you will see on the P&L of your position is that you will be losing money, right? You'll be losing almost close to $500. But that doesn't mean that you need to do anything because you are still in the profit zone. So the profit zone is basically anywhere from this break-even point all the way above. So what you want to do is take note of this break-even point and then you can plot it on the chart. So this way you know if it reaches past that point, past expiration, then you will not be in a loss, but everything else above it, you will be in a profit. So that means if the market is above the break-even or the strike price, right, it's up to you to decide which is the point which you want to use. If you're slightly more defensive, then you want to use the put strike point, right? So in this case, whereby if the market goes past this strike, then you will do something, but if it's above this strike, you do nothing. Or if you want to give the trade more room to move, then you can use the break-even point as a place whereby if the market goes below the break-even point, then you will do something, right? But if it stays above the break-even point, even though it is past the strike price, then basically you can just do nothing, right? Because you are still in the profit zone. So there's really nothing for you to worry or panic about, because if the market just stays there until expiration date, you would still be profitable. Now, what if the market actually goes below the break-even or the strike price? Well, if it does go below the break-even or the strike price, then this is where you may need to do something. Okay, so the first thing we need to understand about short put is that this is an undefined risk. So when it is undefined, it means to say that there is a chance for you to lose much more than the margin you're going to put up, right? The margin you're going to put up, the buying power effect that you're going to put up, right? So in this case, you can see this is the short put position. For putting up this position on the SPY, you would have to put up roughly $6,000 to $7,000 in terms of buying power reduction. And this is being held by your broker, okay? So you will notice the other number is this number, which is the max loss. Right, so the max loss, as you can see, is $37,614, which means to say that the stock essentially goes to zero. Now, In this case, it's very highly unlikely because it's an index ETF. But if you were trading individual stocks, then there is still that risk, right? There's the risk of individual stocks. Let's say, for example, you happen to get into SVB, Silicon Valley Bank, before it went bankrupt, then you would be pretty much facing this big of a loss. All right, not this big, but you'll be facing the max loss on that trade, right? If you put it on. So when it comes to trading short puts, the difference between this and vertical spreads, which is like the bull put spread, is that the bull put spread has sort of like an embedded stop loss in place, because the lower part, let's say for example you were to sell the put option here and then you were to buy another put option there, this makes the bull put spread, you really have the inherent stop loss in place in a sense, right? Because the market can go all the way to zero, but you already have your maximum loss already defined in place, right? So in this case, you don't lose more than the spread width, right, in this case. But with the short put, you can lose a lot more than what you actually put up in terms of the buying power effect. So to prevent you from losing this max loss, what you need to do is that whenever the position reaches this amount, right, you start to lose the buying power requirement which you put up for the trade, the initial buying power requirement, then you want to cut loss, right? This is the most important part, because we do not want your loss to go bigger than this. Because remember, when you are putting on any of the trades, you need to have your capital allocated, right? So the buying power should be a maximum of 5 to 7% of your capital. That means to say, if your trading account is $100,000, that means you can only trade one contract of this short put. So in the event whereby the market really crashes and then you actually hit this loss, right, then this is where you need to get out of the position. Get out of the position to prevent it from growing even bigger. So the most that you will lose is actually only 5 to 7%. So this is very important, because you do not want to let any single trade blow up your account, right? If you hear a lot of stories that people say they trade short put and they blow up their account, it's because they do not have the proper risk management and they did not allocate their capital properly. So as long as you keep it to this percentage, right, and then you cut loss when it hits the maximum buying power effect, this number down here, then you know that it will not be a huge substantial loss on your whole account, right? You can always live to fight another day. So if the market is below the break-even point and your loss equals the initial buying power requirement, then you need to cut loss, right? There is no leeway to this. Once you see the loss hit on your position, you need to be disciplined enough to get out of that position. Now, what if the max loss has not been hit? In fact, for you to actually hit the max loss of this 6,651 is really pretty rare, right? This is almost about something like a 2 standard deviation move, which happens roughly 5% or less than 5% of the time. But of course, there will be times like, for example, the pandemic comes, then you could be in a risk of actually hitting this loss. But for the most part, you're not going to experience this number. So what do you do if the max loss has not been hit? So this comes down to whether it's past the 21 days or not, right? The 21 DTE mark. So this is an important milestone. So I also mentioned this in the other two videos in terms of managing your losing iron condor and managing your losing credit spread. So the main reason why we want to manage this at 21 days to expiration mark as the milestone to see whether we do something or not, well, first of all, it's because the chances of getting a sign on your in the money short put increases, right? As long as your put option is in the money, then there's always a chance for the buyer of the put option to exercise it. And if he exercises the option, you will be assigned 100 shares at $382, which means to say you need to put up $38,200 to long the 100 shares. And if you do not have the amount, then guess what? The broker could put you into a margin call where you need to either put up more funds or they may liquidate your position for a loss, right? So this is one thing that you want to avoid, and the way you can avoid this is by not letting this option trade go past the 21 days to expiration mark. Because the time when the buyer is most likely to exercise their option is when the extrinsic value is very little, right? Extrinsic value is very little when the option is deep in the money. That's where the intrinsic value will be very high, but the extrinsic value will be low. And when there's very little time left, right, in the option, right? That means it's very close to expiration. That's also the time when there's going to be very little extrinsic value, because when the option reaches expiration, all extrinsic value will go to zero. So this is what you need to take note of. So by managing the 21 days to expiration mark, you will ensure that there is sufficient extrinsic value that the put option buyer will not want to exercise. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Now, the next reason why we want to only manage once it's past 21 days to expiration mark is because it reduces your P&L volatility and the chances of the max loss. So most of the biggest losses tend to happen when the option is near the expiration date, and that's because the gamma will start to really pick up, right? When gamma, one of the option delta, starts to really pick up, then what happens is that your pricing, the option pricing, becomes very sensitive to the underlying move, right? When before, if the underlying move, let's say for example, if it moves $1, maybe your option price may only move by around 20 to 30 cents. But if the gamma becomes so big, then guess what? $1 move in the underlying stock could result in maybe a 60 cents move, a 70 cents move. So this way, the whole idea of getting to a short position, right, selling premium, is to let theta work for you. But when the gamma gets so big and the pricing gets so volatile, then guess what? Your theta can be overwritten, right? It's being override by the movement in the underlying stock. So you can also see that in terms of average performance, when you manage at 21 days to expiration, it's actually much better, right? So although the win ratio is slightly lesser than if you hold to expiration, but your return, as you can see, is actually higher than if you hold to expiration. And the reason is because you actually control this number, which is the largest loss, because a big loss like this can really take out a lot of the winners which you have. So when you manage it at 21 days to expiration, you eliminate the big losses that comes with holding all the way to expiration. So you can see down here, this is done by the Tasty Trade team. You can see that they've done a lot of studies and in-depth research into this. Then you can see that if you manage your trade at 21 days to expiration, it's much more superior than you would hold to expiration, right? So that is why we also want to manage it early. So the other thing we also want to take note of is the risk profile at 21 days to expiration. You see, it is possible that at the 21 DTE mark, you can actually almost reach full profit of this short option, right? So let's say, for example, this is the price which you started off when you first put on the short put. Now, the market does not have to really move a lot in order for you to reach almost full profit. Let's say, for example, if it just moves $5 to 400, the $400 mark down here, you will see that actually you have already made roughly about 3/4 about the profit, right? About the max profit, roughly 3/4 of the max profit. So there's no need for you to hold even an additional 21 days and then you risk losing all this money. If you see, if it goes all the way to 410 even, you're pretty much almost at the max profit already. The other thing is that if you notice, this purple line will start to become even more and more steeper as time passes, right? As it gets close to expiration. So that means to say, for each day you're holding on to this position, a small move in the underlying stock can really have a big swing in your P&L, right? So let's say, for example, if it goes up, right, just a little small move, you'll be able to make quite a bit in terms of profit. But at the same time, if it moves against you, then guess what? You're going to lose a lot more as well. So at this point of time, it comes down to a lot of luck in terms of where the direction will go to, instead of letting time decay work in your favor. So if the max loss is not hit and there's still more than 21 days to expiration left, then guess what? There is nothing to do, right? The market can come down. You just want to give it time because it could come back up again. And if it does come back up, then there really is no need for you to have aggressively manage this, right? It could still be in a profit just as it is. Remember, this is a probability game, right? When you put on a short put, let's say for example you put on a 30 delta short put, then there is roughly a 70% chance of profit, right? So you just need to let the numbers play out. Now, if the max loss is not hit, but there's less than 21 days to expiration left, then this is where you need to do something, right? So there are three options that you can take. So the first option is to simply take a loss, right? You can always take a loss and then find another setup again and then enter into a trade. And this is the approach that I like the most, and the reason is because I have many trades going on at one time, right? If you have watched many of my other videos, you notice that I do not trade too many underlyings at one time, and I like to have many positions on the single underlying. So in this case, let's say for example I have an index ETF like the IWM or the spiders. I'll have many positions on. I'll have like the iron condor, the strangles, the put spread, the bear call spread, short put, this kind of trades on many at one time. So I do not really want to manage every single trade, right? Because if you have many trades and then you want to manage every single one, it can get a little bit confusing. Rather, you can just let the probabilities play out, because if you just leave it as it is and just take loss, over the long run, it will still be in a profit, right? As long as you stick to the proper mechanics to place on the trade. So even though you take a loss, it's not going to be a big setback to this whole strategy, because remember, this is a 70% win rate kind of strategy. If you put on the 30 delta short put, that means to say there's still a chance to lose 30%, right? So when there's this loss, right, you just want to take it, rather than if you choose to do something, let's say for example you decide to roll it down, then there's a chance to further aggravate those losses, because if the market still continues to crash, let's say for example like the SVB situation, the Silicon Valley Bank, then you're going to actually lose much more than compared to if you have just taken the loss initially, right? So this is the first option and the simplest one. Now, the second option would be to roll it out, right? So if you still have a bullish take on this and you think that the market can rebound, you think that the market is pretty oversold, then you can choose to roll out, right? So when you're rolling out, you are actually getting more credit again, and when you have more credit, it helps to buffer to the downside in case the market continues to move lower. But at the same time, if the market does come back up, then you're going to make a little bit more as well, because each time when you roll, you're going to receive credit. And the good thing with short put is that most of the time, even though it is in the money, you still can roll for a credit, right? So if you're not very sure on how to roll short puts, I actually have a whole video on rolling short puts. It's called Rolling Short Puts Masterclass. You can go to my channel and watch that video if you haven't watched that already. So this is option 2. And the third option, last but not least, is rolling out and down, right? So rolling out means to roll out to the next expiration date, to the further expiration date, and you also roll it down as well. So this way you give more room for yourself to be right. So let's say for example from 380, let's say you're able to roll the put option down to 375, then guess what? You've also pushed your break even down as well. So if your break even is lower, then you will have a higher chance for this trade to work out as well, because in the long term, stocks and index ETFs are in this case do want to go up, right? Of course, if you choose the right index ETF and the right stocks, they have good fundamentals, right? In the long term, they do eventually want to go up. So if you were to just keep rolling it, rolling out and down each time, eventually there will be a time whereby your whole position can be taken out for a profit. So let's just have a very quick summary of what we just went through. So first things first, if the market has not breached your short put strike or your break even, depending on which one you choose, then there's nothing to do, right? Next thing is, if it has breached your put option or your break even point and it has reached your maximum loss, then you need to cut loss, right? There's no point for you to try and wait and see, because it could get even worse. So the best is to take your loss, move on to the next trade. Now, if the max loss has not been hit and there's still more than 21 days to expiration, again, there's nothing to do, because there is always a chance for the trade to come up. So you just need to give it time, give it room for it to work out. Now, if the max loss has not been hit, but there's less than 21 days to expiration, then there are three options to take. Either you can take loss, you can roll it out, or you can roll out and down. Alright guys, that's it for this video, and I hope you found this video helpful. And if you like this video, please give me a thumbs up and also subscribe to my channel as well. This way I can create more videos like this for you. And last but not least, thank you for watching. I appreciate your time, and may the options favor you.